Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for Wednesday, November 11th. My name is Will Gibson. I'm joined by Sarah Maley today, also today known as Veterans Day in the United States. So we do want to emphasize and just take a moment to thank all of those that have served and are currently serving to protect our country for so many freedoms, the right to vote, as many of us have previously been given the opportunity to do so, as well as freedom of expression and so many others that we tend to take for granted. And Sarah, I know this is a day very close to home for you and your family. So with that, maybe we would like to start with you today on the market perspective. I know we have some general observations from an asset class, sector, maybe some rotation, maybe not, that you could start by adding some color on.
Yeah, thanks, Will. And yes, happy Veterans Day to all of those who have served and those who are serving. My father is retired Army, and both my grandfathers were retired Navy. So, like I said, close to my heart. But getting into the market stuff, we do have a lot to cover today. We kind of came out of the gates this week with a massive laggard rally. We saw small caps up. Let's see, through yesterday's close, IJR, so that's the S&P Small Cap 600 Index Fund, we saw that rise a little over 7.5%. And right behind it, the Invesco S&P Equal Weighted ETF RSP up 4.86%. And again, that's through yesterday's close, not counting in Wednesday's action. So those are areas, we've seen lagging other areas of the market. Also the Dow, the SPDR Dow Jones Industrial Average ETF was up a little, just shy of 4%. So when I was looking over these major market ETFs, I noted that so IGH, which is the small cap representative, SPY, so it's the cap weight S&P, and then RSP, like I mentioned, the equal weight S&P ETF, they all reached new all-time highs on Monday. The Dow, DIA, it has met its February high, but we do note that each of those funds now is trading at all-time highs. IJR, so that's the small cap fund that I had mentioned already, like I said, up a little over 7.5% through yesterday's close. We do note that, even with this massive rally that we've seen, IJR is actually still below its February or January high. And then its all-time high actually was printed in August of 2018. So, while we have seen small caps rally, we still, from an absolute perspective and a relative perspective, that is still a weaker area. Small caps are still down on the year, but that is an area to watch to see if we can, find any follow through there. As far as QQQ goes, that is a fund that I've personally been watching. We talked over the past few weeks in our report that this particular chart has formed a triangle pattern, which is formed with 5 columns. So, we've officially met the triangle criteria. From here, a move to 300 or higher would complete a bullish triangle on the QQQ, while a reversal into O's and a break down at 265 would actually complete a bearish triangle. And what I think is notable about this is we haven't seen any changes on this chart even over the last week. The Qs from Monday through yesterday's close, so Monday and Tuesday, down a little over 3.8%. But we haven't seen any of Monday's, kind of tech sell-off. It's not reflected on this chart yet. And so what that tells us is, with point and figure charting, we want to chart, only kind of significant moves. And what this is telling us is that Monday really was a non-event as far as the QQQ goes. So this is, again, something that we're watching. Tech still remains strong, and QQQs looks like, it's still holding up. So be sure to set an alert for that 300 mark. And a move to 305 or higher would actually mark a new all-time high for this fund. So getting over actually into the sector discussion, I just mentioned technology. Technology still ranks number 1 in Dolly. It has ranked number 1 for quite some time now. And right behind it, we have consumer cyclicals. And cyclicals are an area that we've also been keeping up with, kind of the stay-at-home trade. And we've actually seen that gap between technology and consumer cyclicals narrow. Just last night, it is now it reduced by 7 signals. So their number 1 and number 2 are now separated by just 4 RS buy signals. So be sure to set your dolly alerts. I think that this is something definitely to watch. Cyclicals, while they have been strong, we do note that a lot of the stocks that have been strong within that sector. So let's say like Nike and Crocs, Home Depot, stay-at-home names like that, names that have actually thrived off of our stay-at-home economy. Those names that have looked strong simply pulled back from overbought territory on Monday. Whereas, the weaker names within the cyclical sector, so the stocks that, the reopening stocks, which rely on a fully operating economy. So AMC, the movie chain and Caribbean Cruise Lines, those, had massive rallies on Monday. But we haven't seen much follow through. Those names are still looking weak. Carnival Cruise Lines, for example, did move back into a positive trend, but it hasn't broken through any sort of additional resistance. And, with yesterday's action, they actually pulled back. So we are watching to see if these, reopening names can gain some steam, but overall, we are still seeing kind of that stay-at-home trade, hang tight. So I think another interesting thing that we will note here, just in terms of Dolly, is international equities. We saw international equities move up into the number 4 spot today. So that was after yesterday's close, which we will provide more information on that, more color in today's daily equity report. But within international, we did see developed markets actually rally over the last week, along with small caps. So again, both areas that have been relatively weaker. They do both remain weak areas, like I said. So we need to see if both can, show some follow through. But within international, emerging has just been the place to be. So with that said, I know that over the past week, we've put in tons of stats in our report. We've kept you up to date as much as we can, especially with everything changing so fast. And Will, I know you wanted to kind of review some of those stats to put some more color just to some of the things we're talking about.
I definitely will, Sarah, and I'll tack on that. I think you also provided a great amount of color in just a bifurcated, just crazy week for the market. And you mentioned a few names that have really participated this week. We would classify those as the laggards, those that have struggled on the year and really beyond that. Those have done, as Sarah said, extremely well. And then those that have been doing really well this year have not participated as much this week. So, for example, year to date, you have your Nasdaq composite up over 30%, your S&P 500 almost up 11%, and then the Dow is up just over 3%. And this week, that was not the order of participation that we've seen. So talking about participation, but also spread, I'm going to start on the first point on the more statistics side. So on the participation front, we have a few indicators that we'll like to follow, many of which are participation based. 2 that I'm going to hit on today real briefly are one's called positive trend for the S&P 500, abbreviated PT, SPX. It's a participation-based indicator of the number of stocks in the S&P 500 trading in positive trends. So this week, we saw the indicator have its biggest single-day change ever, which we saw it gain 13%. So that tells us 13% more stocks in one day return to a positive trend. So massive number, massive improvement for that indicator. The other one I'll mention is the bullish percent for the S&P 500. So same universe, except instead of positive trends, we're measuring point figure buy signals. And that indicator jumped 20% this week in one single day, which is the 4th largest ever. And just to brace yourself, we're going to be saying that a lot the rest of the podcast. This hasn't happened since or largest ever. We really don't get to say that a lot. Seems like 2020 we've set a lot of records this year in the market and in other places. But those 2 indicators wanted to mention on the participation front, tons of participation in one single day, despite the massive spread that we had between the leaders and laggards. And we're going to hit on that leaders and laggards a little bit more here as we go through. But before we get to that, I want to touch on the just pure index performance spread that we saw. So as we mentioned, we saw the Dow rally early this week, posting significant daily gains, whereas your more tech heavy Nasdaq composite, those leaders on the year, did not do nearly as great. And to the point where the spread was the largest, the 41st largest that we have seen. You may be thinking, 41 doesn't really sound like all that impressive of a number. But if you go back to 1972, every trading day, that puts itself really high on the list in terms of rarity. And what we have shown on the screen are some forward returns for the three major indices in our study. So the Dow, the Nasdaq, and the S&P 500. The days we saw the largest spread, we ranked them, and those top 50 days with the largest spread, how did the best performing index do going forward, and how did that worst performing index do going forward? And you'll note that they're all negative returns here. That is not an ominous statement by any means, but just note that there's a lot of mean reversion events that tend to come into play when looking at data sets like this. I'll also note the years that these type of spreads happened. The year 2000, we saw 30 of our top 50 observations come in. And if you know anything about year 2000, tech boom, tech crash, a lot of events involved with that. So take it for what you will. But point being, huge leader laggard spread earlier this week, and definitely wanted to drive home the rarity of that in that discussion. Other thing I'm going to mention on that leader laggard spread is not only from a sector view, not only from an indice view, but also from a style view. So we saw the biggest spread in favor of value ever on Monday. The only bigger absolute move spread that we saw between value and growth historically took place in January of 2001. So really undermining the rarity of the events that we're seeing this week. Huge spread for sectors, huge spread for indices, as well as some of the style groups as we're showing here. Now, I do want to also mention as a more tangent point that we don't want to overlook just general S&P 500 performance. We had a 6-day stretch where at one point in the day, the S&P 500 had almost rallied 10%. And so in 6 trading sessions, the S&P rallying to 10% is no small feat. As you can see in this top table here, it doesn't happen often in history. And apart from that year 2000, once again, it generally lent itself to positive returns in the following months. This isn't meant to be predictive in nature. None of these tables or stats that we're showing are meant to be predictive in nature, but really just to drive home the spread, the underlying participation across the board. And really this week, it hasn't been from those names on the year that we've expected to see. Something else that I'm just recalling in my mind, I remember on Monday, the top 20 best performing stocks on the year were down an average of 8% an hour going into the close, whereas your worst performing 20 stocks on the year were up around 22%. So you can pull stats from all over the place, but by and large, it's a day for the books. It'll be a day on our tables going forward, and we wanted to share that with you all today. But as we round the corner here, maybe to the end of our podcast discussion, we do want to emphasize that a massive weekly move for a number of names. Sarah categorized it earlier as a non-event for some of those leaders. They did not materially suffer by and large. They just didn't participate as much. So as of right now, we're looking at the asset class group scores page. If you're with us on YouTube, or as Sarah started with, we talked about Dolly, both macro asset views, kind of asset allocation things on the platform that you can use to overweight, underweight, or get some guidance. So on that perspective, high level, we haven't seen any material change just yet. This isn't to say that it's not happening, and it's not to say that there could be some rip currents underneath the surface. But in terms of practical take-home moves right now, it hasn't warranted any massive overhaul changes.
Yeah, just the fact that, again, long-term leadership remains in place. As you can see right here on the asset class group scores page, still growth over value, despite the value kind of rally that we saw on Monday. This is a good week to just remind yourself that, for us, we always talk about sticking to your rules. So sometimes weeks like this don't necessarily feel good, but, sticking with those long-term leaders, sticking with your process, that's something that we'll always coach you on. And with that said, if you have any questions, you can always call our research team at 804-320-8511. And with that, Will, I think we're all set.
Absolutely. Yeah. Sarah, thanks for joining me. And thank you all for tuning in. We wish the best to veterans, those have served, currently serving, and we will look forward to talking with you all next week.